Did you know that by 2026, 10 new UK laws could quietly drain your savings, raise your bills, and even delay your retirement? These aren't distant possibilities. They're decisions already being shaped in Parliament right now. From the rollout of a digital pound that could track every purchase, to new tax rules, pension shifts, and property levies, millions of households may be caught off guard. Imagine opening your payslip, your energy bill, or even your inheritance letter, and finding it suddenly slashed by rules you never knew existed. The question is simple: are you really prepared for what's coming? Number 10. Consumer debt regulations. By 2026, the UK is preparing for tougher rules on consumer borrowing, aimed at protecting households from spiraling debt. One major change is the proposal to cap interest rates on credit cards, payday loans, and other short-term lending products. While this move is intended to shield vulnerable borrowers from predatory practices, it will also make lenders more selective about who they approve. For households with strong credit histories, access to borrowing may remain straightforward, but for those already struggling financially, stricter approval processes could mean being denied loans altogether. This could leave many families without the safety net they once relied on during emergencies, creating new challenges in times of crisis. Another element of reform is the introduction of stricter affordability checks. Lenders may be required to analyze not just income, but also spending habits, housing costs, and even utility bills before extending credit. These measures are designed to prevent people from taking on debt they cannot realistically repay, yet they also raise concerns about privacy and access. Families accustomed to using credit as a bridge between paychecks may find themselves cut off. Moreover, debt collection practices are likely to face tighter regulation, with new standards to ensure fair treatment. This could provide relief for those already in financial difficulty, but may also limit repayment flexibility, as lenders seek to minimize their own risks under the new framework. For individuals, adapting to these changes means developing stronger financial resilience. Building emergency funds, reducing reliance on short-term credit, and seeking out financial education resources will become more important than ever. Alternatives such as credit unions, which often provide fairer lending terms, may see rising demand. At the same time, households will need to carefully monitor their credit records, as good ratings may become the key to securing affordable borrowing in the new system. By 2026, the consumer debt landscape will look very different. Borrowing may be safer in theory, but access will be harder. For many, the challenge will be finding ways to thrive financially without leaning so heavily on credit. Number 9. Immigration and work visa fees. By 2026, the UK's immigration framework is set to evolve further, with higher visa and work permit fees forming a key part of new policy changes. For many sectors that rely on overseas workers, healthcare, agriculture, construction, and hospitality, these adjustments could significantly raise operating costs. Employers may be required to shoulder larger fees when sponsoring workers, but in practice, much of this financial burden is often passed on to consumers. That means ordinary households could see the cost of food, services, and healthcare quietly increase as businesses try to recover expenses. The policy is designed to reduce dependency on foreign labor and encourage more local recruitment, but the short-term reality may be tighter budgets for both companies and families. For individual workers, higher visa costs will pose new barriers. Migrants already face significant expenses when moving to the UK, and the introduction of steeper fees could discourage skilled professionals from choosing Britain as a destination. In critical areas like the NHS, where staff shortages are already severe, the consequences could be far-reaching. Patients may experience longer waiting times, reduced access to specialists, and an overall decline in service quality. Meanwhile, small employers in farming or seasonal industries may struggle to fill positions at all, leading to reduced supply and higher prices for essential goods. This ripple effect underscores how immigration policy, though often framed as a national security or political issue, can directly affect household economics. For families preparing for these shifts, awareness will be the strongest tool. Understanding how labor shortages may influence everyday costs can help people anticipate changes in their budget. It may also encourage workers to develop new skills, positioning themselves for opportunities that emerge as industries seek to reduce reliance on foreign labor. For businesses, exploring automation, training programs, or local recruitment drives will be crucial to offset added visa expenses. By 2026, immigration and visa fee reforms will not just reshape the job market, they will reshape the household wallet. Ordinary citizens may not apply for visas themselves, but the costs tied to them will echo through supermarkets, hospitals, and high streets across the country. Number 8. Savings and ISA reforms. By 2026, the government is expected to review and potentially reshape the rules around savings and individual savings accounts. These accounts have long been a popular way for households to grow money tax-free. But proposed reforms could change how much people are allowed to save each year without facing new charges. The annual allowance for ISAs may be adjusted or even reduced, meaning that savers who regularly maximize their contributions could lose part of their shield from taxation. At the same time, there are discussions about whether investment-based ISAs, such as stocks and shares ISAs, should face tighter restrictions, especially for higher earners. These shifts may look technical on paper, but for families relying on ISAs as their main financial cushion, the results could be significant. Another area of focus is the tax treatment of investment earnings. At present, interest, dividends, and capital gains within ISAs are sheltered, but the government has hinted at introducing partial taxes on certain categories of returns. This would especially affect long-term investors who use ISAs not just for rainy day funds, but for retirement planning. Savers may also see changes to how lifetime ISAs are managed, including stricter withdrawal penalties or altered age limits for accessing funds. While the aim is to close gaps in the tax system and ensure fairness, the reality is that ordinary savers could see their returns shrink, making it harder to build financial security over time. The risk is that what was once a safe and predictable shelter for savings could become less generous, pushing people to search for alternative options. For households preparing for these changes, the best approach is to diversify saving strategies. Using pensions, regular investment accounts, or even newer digital financial tools may help spread the risk of policy changes. Keeping an eye on official updates is also essential, as small adjustments to allowances or rules can dramatically alter how much is gained or lost. Financial planners often recommend reviewing contributions annually and balancing short-term access to money with long-term growth. By 2026, ISA reforms may no longer guarantee the same level of protection, but with proactive planning, families can still safeguard their savings and adapt to the evolving financial landscape. Number 7. National insurance adjustments. By 2026, the UK is preparing to reshape how national insurance NEI contributions work, and the impact could be felt in every worker's payslip. One proposal being debated is the possible merger of income tax and NEI, a move that would simplify the system but potentially raise the overall burden on employees. At present, NEI is often seen as a separate charge, yet merging it with income tax could make deductions more transparent, and for many, more painful. Another scenario being discussed is the gradual increase of NEI rates, with workers and employers both contributing more. The government argues this is necessary to fund pensions, healthcare, and social services, but households may see it as another drain on already stretched wages. For employees, higher NEI means less disposable income, and for employers, it means higher payroll costs. This could push some businesses, especially small and medium-sized enterprises, to limit hiring or wage growth. For younger workers already facing student debt and high living costs, the reforms could make saving for the future even harder. Meanwhile, the self-employed are likely to see targeted adjustments to their NEI obligations. While past reforms have reduced certain benefits for the self-employed, new rules may require them to contribute at levels closer to traditional employees. This could feel like a heavy blow for freelancers, contractors, and gig economy workers, who often lack the safety nets that full-time employees enjoy. Despite the challenges, there are ways individuals can adapt. Exploring salary sacrifice schemes, where part of income is exchanged for benefits like childcare support or pension contributions, can lower NEI liabilities. Keeping track of thresholds and allowances will also help avoid paying more than necessary. For the self-employed, planning ahead with accurate record keeping and early tax saving is essential. By 2026, NEI reforms will highlight a broader truth. The cost of social welfare will increasingly be shared across the workforce. For ordinary people, the shift will not just be about higher deductions, but about carefully planning how every pound of income is earned, saved, and spent. Number 6. Energy and climate levies. By 2026, households across the UK are expected to face new climate-related charges on their energy bills. These reforms are tied to the government's broader commitment to reach net zero emissions. But they come with a financial cost. One likely change is the expansion of green energy surcharges, which are small add-ons designed to fund renewable energy projects and environmental initiatives. While these may sound modest, when combined with rising global fuel prices, they could make electricity and heating noticeably more expensive for average families. For many, especially low-income households, this could feel like being punished for simply keeping their homes warm during winter. The reforms also aim to encourage reduced consumption. Yet for people with older, less efficient homes, reducing energy use is not always a practical choice. Another critical aspect of the reforms involves home insulation and environmental compliance. Homeowners may soon face legal requirements to upgrade insulation, install double glazing, or replace outdated boilers with greener alternatives. Although these measures could lower energy bills in the long term, the upfront costs are daunting. A new heating system or insulation project can cost thousands of pounds, and government subsidies often do not fully cover the expense. Landlords may also face stricter rules requiring them to bring rental properties up to higher efficiency standards. If they cannot afford upgrades, they might exit the market, leaving tenants with fewer housing options. The overall result could be a housing sector under pressure, with costs passed down to renters and homeowners alike. For households looking to prepare, the key will be planning ahead, exploring government grants early, setting aside savings for possible upgrades, and gradually improving energy efficiency can soften the impact when rules tighten. Simple steps such as switching to LED lighting, improving insulation where possible, or installing smart meters can already reduce usage. On a broader scale, these changes reflect a trade-off: short-term financial strain in exchange for a more sustainable future. Yet for families already balancing high living costs, the reforms may feel less like a green opportunity and more like another bill they cannot escape. By 2026, managing household energy will not just be about comfort, it will be about survival in an era of rising environmental demand. Number 5. Property tax overhaul. Property has long been viewed as one of the safest investments in the UK. But by 2026, significant property tax reforms may challenge that belief. Rising housing prices have pushed wealth into real estate, and the government is now eyeing new ways to raise revenue from this sector. One proposal involves the introduction of regional property levies, where households in higher value areas could face steeper annual charges. For families in London, Manchester, or other growing cities, this might mean paying thousands more each year simply to own their homes. Meanwhile, the government is also considering adjustments to stamp duty, particularly targeting second homes and buy-to-let properties, to discourage speculative investment and free up housing for first-time buyers. For landlords, these reforms could present serious financial difficulties. Higher stamp duty, coupled with potential annual surcharges, may shrink profit margins on rental properties. Some landlords might respond by raising rents, which would place further strain on tenants already struggling with high living costs. Others could sell off properties entirely, reducing the availability of rental housing and fueling greater competition in the market. Homeowners, who have worked hard to climb the property ladder, may also feel penalised, as their assets attract more tax despite no increase in their disposable income. The message is clear: property ownership will come with heavier responsibilities and higher recurring costs. For individuals and families, preparation will be essential to weather these changes. Prospective buyers may need to budget not only for mortgage repayments, but also for new tax obligations that could raise monthly expenses substantially. Those considering buy-to-let investments should weigh whether future returns can still justify the upfront and ongoing costs. Homeowners may also explore energy-efficient upgrades, as certain reforms may link property levies to environmental standards. By 2026, the government's strategy to rebalance the housing market could create winners and losers. First-time buyers may gain new opportunities, while landlords and established owners may shoulder heavier financial pressure. Either way, property will no longer be a passive store of wealth. It will demand careful planning, ongoing investment, and strategic foresight. Number 4. Inheritance tax reform. In 2026, the UK is expected to push forward with inheritance tax (IHT) reforms and these changes could quietly affect families across different income levels. Currently, many estates are protected by tax-free allowances, but proposals suggest these thresholds may be lowered, drawing more households into the tax net. With rising property values, especially in London and the southeast, ordinary families who never considered themselves wealthy may suddenly face hefty bills after a loved one passes away. This shift could create emotional and financial strain at an already difficult time, forcing heirs to part with a portion of their inheritance just to comply with new obligations. For those who see property as the cornerstone of family wealth, the reforms could feel like a direct challenge to long-term security. Beyond thresholds, policymakers are reviewing how gifting and asset transfers are treated. Currently, gifts made more than 7 years before death often escape taxation, but proposals indicate this window may shrink or be subject to tighter reporting requirements. This would limit the flexibility families have in passing on wealth and could trigger unexpected liabilities for both donors and recipients. Agricultural land, business assets, and family homes, traditionally granted special reliefs, may also face new restrictions. The argument is that the system must adapt to close loopholes, but for families trying to preserve a legacy, it means rethinking estate planning entirely. Solicitors are warning that without proper planning, heirs could be forced to sell property or dip into savings to cover sudden tax demand. For households hoping to prepare, several strategies are emerging, making early use of available allowances, such as annual gifting exemptions, remains important. Families may also need to consider life insurance policies designed to cover future IHT liabilities, or explore trust structures where appropriate. While these options add complexity, they may prove essential in protecting generational wealth. The broader message is that inheritance tax reform won't just affect the ultra-rich. It could touch middle-class families who once assumed they were safe. By 2026, IHT may become a more common concern, reshaping how families think about savings, property, and the financial legacy they hope to leave behind. Number 3. Pension age and contribution rules. By 2026, one of the most sensitive financial changes will concern pensions. The UK is gradually raising the state pension age, and future adjustments could mean millions working longer than they expected. For younger workers, the idea of retiring at 68 or beyond is becoming increasingly likely, while those nearing retirement may discover they need to wait additional years to access full benefits. This shift is often justified by longer life expectancy and the rising cost of pension support. Yet for many citizens, it feels like moving the finish line just when it's within sight. Those in physically demanding jobs, nurses, construction workers, or carers, may find the new rules especially harsh, as extending work years takes a toll on health and well-being. Beyond the retirement age, the government is also considering stricter contribution requirements for private pensions. Minimum contribution levels could be raised, with employers and employees both expected to pay more into workplace pension schemes. While this may increase long-term security, it also reduces short-term disposable income for households already struggling with living costs. For self-employed workers, the pressure might be heavier, as they are responsible for their entire pension savings without employer support. If contribution rules become more demanding, many could face difficult choices between saving for tomorrow and paying for today's essentials. The financial planning landscape may shift dramatically, requiring workers to reassess how much of their monthly income must be diverted into long-term accounts. For individuals, preparation is essential. Reviewing workplace pensions, checking eligibility for tax relief, and exploring supplementary savings vehicles like ISAs could soften the blow of stricter pension rules. It may also be wise to consider delaying retirement voluntarily, even if not required, to maximize payouts and maintain stability. Those approaching pension age should keep track of government announcements closely, as sudden changes can reduce expected income streams. Ultimately, pension reforms are designed to ensure sustainability. But for households living paycheck to paycheck, the rules may feel less like protection and more like an extra burden. As 2026 nears, the question for many will not be whether they can retire comfortably, but whether they can retire at all. Number 2. Changes to income tax brackets. By 2026, the UK government is expected to make adjustments to income tax brackets that could directly affect the take-home pay of millions. These changes often happen quietly, yet their impact is felt in every payslip. One major factor is fiscal drag. which occurs when tax thresholds fail to rise in line with inflation. As wages increase slightly to match the rising cost of living, more people are pushed into higher tax brackets. What feels like a small pay raise can quickly turn into an unexpected tax burden. Families who were once just under the higher rate of tax may find themselves paying hundreds more each year, even if their real purchasing power has not actually improved. For higher earners, the pressure could be even sharper. The government has already signaled interest in reviewing top tax rates, and by 2026, there may be steeper contributions from those earning above certain thresholds. While this is often justified as a way to increase fairness and fund public services, it could also discourage investment, savings, and even certain career moves. Professionals may hesitate to take on overtime, promotions, or additional roles if they believe the financial benefits will be swallowed by taxation. Meanwhile, middle-class households, already balancing mortgages, childcare, and rising living expenses, could feel squeezed from both sides. Their modest wage growth might not keep pace with inflation, yet the tax system could still demand more. Practical preparation is vital for households that want to avoid being caught off guard. Experts recommend checking whether salary increases, pension contributions, or side earnings could move you into a different bracket. Making use of tax relief options, such as pension top-ups, ISA investments, or allowable work expenses, can soften the blow. Employers may also introduce salary sacrifice schemes that let workers trade part of their income for benefits, such as childcare vouchers or bike-to-work programs, reducing taxable pay. For individuals, awareness is the first defense. Understanding how thresholds are set and where your income falls can prevent surprises. As 2026 approaches, income tax reform could quietly reshape household budgets, leaving many people wondering why their wallets feel lighter, even as their wages appear to grow. Number 1. Digital pound rollout and cash limits. The UK government is preparing for the launch of the digital pound, often described as a central bank digital currency, CBDC, in 20. Unlike physical cash, the digital pound would exist entirely online and be issued directly by the Bank of England. Supporters argue it will provide faster, more secure payments and help the government monitor financial stability. Yet, for ordinary citizens, it raises big questions. Many fear what it might mean for privacy, cash independence, and even spending freedom. At the same time, restrictions on large cash transactions are being debated, with proposals to limit cash payments above certain thresholds to combat tax evasion and money laundering. For those who rely heavily on cash, especially older generations, these changes could feel like losing control over their money. One key concern is how the digital pound might affect personal saving. While banks already hold deposits electronically, a direct digital currency could allow people to store money with the Bank of England instead of commercial banks. This could put pressure on traditional banks, which rely on deposits to lend out loans. If banks face reduced deposits, they may raise fees or tighten lending standards, which would trickle down to the public. Everyday households could find mortgages, personal loans, and even overdraft facilities harder to access or more expensive. Another potential issue lies in transaction tracking. With a digital pound, every purchase could leave a permanent digital trail. While this might help fight crime, it could also reduce personal financial privacy, creating unease about how much the government can see or control. For people managing budgets, the combination of a digital pound and cash limits might mean adjusting long-held habits. Cash-heavy businesses, such as small shops, local markets, or family-owned restaurants, could face higher operational challenges if cash becomes harder to use. Customers, too, may find themselves nudged toward cashless systems, whether they prefer them or not. Experts suggest preparing by adopting secure digital payment methods early, becoming comfortable with banking apps, and understanding how to safeguard personal data online. While the rollout is presented as modernization, the everyday reality for millions could involve tighter spending rules, reduced privacy, and fewer choices in how money is handled. As the UK moves toward 2026, it's clear that these 10 laws could reshape everyday life and personal finances in ways many people are not yet prepared for. From tax adjustments and pension reforms to property levies and the rollout of a digital pound, the rules shaping money are changing faster than most households can keep up. For some, the reforms promise fairness and long-term stability. For others, they bring heavier costs, stricter controls, and fewer choices in how money is earned, saved, or spent. What unites them all is their reach. No household will be untouched. Preparation will be the key to weathering these changes. Staying informed, reviewing personal finances regularly, and making small adjustments early can prevent bigger shocks later. Whether it's exploring new saving strategies, planning for retirement, or adapting to energy and property requirements, proactive steps can ease the pressure. These shifts are not just political debates, they are real changes that will affect paychecks, pensions, and even the weekly shopping bill. By understanding what lies ahead, families can move from being vulnerable to being ready, ensuring that when the laws take effect, they are not caught by surprise.